Guys, it's been a long time since we did Starbucks. It is back. It is up not only 90% in the last 5 years. In the last 1 year, it's up 13% year to date. It's basically even. There's a lot of talks of unions going on for Starbucks. So in this video, we're going to go over the basics. We're going to go over more advanced topics. There's something in here for everyone. No matter where you're at, it's great to reiterate the basics, and it's great to learn more things as time goes on. We're going to go over some analyst estimates, some bull and bear cases, our 8 pillars about Starbucks, and then we're obviously going to finish it off with the most important question that you're probably trying to figure out. What price should I pay for Starbucks? Now remember, more research has to go into that, but the stock analyzer tool will help give us a value for Starbucks that even says, should we be spending more time on this company? Mo, Starbucks, for the first time ever, like a few years ago, started closing down stores. So one of the things I want you to do is go look through their 10K, which is accessible through our website right here at the bottom on annual reports. Takes you right to the SEC website and takes you right to Starbucks. We'll figure it out. But Starbucks, $115 billion market cap. That means if you bought every share on the market outstanding, that's what you get. 3.3 times sales. Remember, NVIDIA's 42 times sales, which is crazy. They made about $3.8 billion in the last year, average 3.1 in the last 5. Awesome. Free cash flow, about $3 billion last year and over $4 billion in the last 5 years. So a lot better than their net income. Their free cash flow is actually higher than their net income over the last 5 years. That's a positive sign. Usually it's the other way around. You have to start asking questions. Why is it different? Are they doing something to the books, etc.? But when the cash flow is higher than net income, it makes us feel better inside, warm and fuzzy. All right. PE currently though, 30. 5-year PE, 37. Okay, seems a little rich, but Starbucks is clearly a moat type business. People would literally not feed their children in order to get their Starbucks every day. That's a pretty big moat.
That's Nicole. Teddy hasn't eaten in like 3 days. It's weird.
Or the other thing about the moat is Starbucks can literally have across the street from each other. This is a joke 20 years ago, but now it actually happens. There are Starbucks across the street from each other and both are packed.
I think there's a place in New York City that has one on each of the 4 corners.
As I just said, across the street from each other.
Well, you didn't say across the street and across the street.
Wait a second, you said on all 4 corners?
Yeah, all 4 corners.
Please Google that.
I swear I've seen that before.
4 corners.
Yeah.
If that's the case, I'm going to put half my net worth in Starbucks right now. Just kidding. So, very consistent profit margin. 10.8% last year, 10.9% over the last 5 years. Very, very consistent. I'm actually surprised by this gross margin. 26%. I'd have thought much higher. Much, much higher. All right, guys. A dividend here, 2.1%. It eats up $2.4 billion of their cash flow. So, guys, remember, we want you to learn this. For those of you who are new to the channel, dividends aren't a guarantee. Everybody out there, I'm on Twitter, and everybody's like, oh, dividends are king. It's like, no, shut up about the dividends. First off, it's not free money. Secondly, dividends are only as good as the cash flow coming in the business. I look at this at $2.4 billion of their $3 billion last year and go, that's 80% of their free cash flow. That's a lot of their free cash flow. Now, over the last 5 years, it's a much better number. Maybe it's 60% or 55%. So that's much better, but hopefully their free cash flow is going to rebound and get much higher and grow from here. What would you find it?
It's like 3 out of 4.
Oh, it's not even a corner. It's on the same freaking side.
Yeah.
29th and Park, 31st and Park, and 29th and 5th.
Yeah, but then look at this when I zoom out. This is New York. Look at that.
Yeah, that's great.
Isn't that crazy?
I'm actually surprised there aren't more.
Yeah, me too. Me too.
All right. So let's check out the 8 pillars on Starbucks. Oh, not as good as I thought. So guys, remember, if you have our software, you can customize your pillars up to 12 pillars and 4 quadrillion variations. But Mo, look at this. We've got 4 X's and 4 checks. And of course, the metrics, the financial metrics, the 5-year PE is 37. The 5-year price of free cash flow is 28. And remember, the 5-year price of free cash flow is lower because they're reporting more cash flow than earnings. That is, again, a positive sign here. Buying back some shares. Okay. They're buying back 17% of their shares in the last 5 years, but this is an expensive company. Is that really the smart thing to do?
The cash flow is rather erratic.
Is it?
Yeah. I mean, look at this. Look at the last 10 years.
Erratic or erotic?
Both.
Yes. What's the last 10 years?
I mean,
let's pull it up.
Negative 443, 2.2, 2.9, 3.15, 2.7, 10.5. negative 450 million, 4.6, 3.4, 3. I mean,
yeah. But you know, the
place.
negative 450 offset by the positive 10.5. Okay. Oh, and declining over the last few years too.
Mm-hmm.
I know they're closing a lot of, not a lot of stores. Can you pull that up?
Here's their total number. I haven't looked up closing yet, but here's their total number of stores. So here's your total number in the United States, total number internationally, and total.
Oh, so look at that. 35,000 last year, 37,222.
Yep.
Well, then that was wrong. Net very much opening stores. How many licensed? Oh, I didn't realize there were that many licensed stores.
Neither did I.
Interesting.
And they're increasing too.
Look at North America, much slower growth than international. And guys, we talk about this all the time. We talk about this all the freaking time.
Yep.
International growth is where a lot of companies here in the US are going to see their growth, because we talk about expanding markets in China, India, and eventually Africa will be the next frontier of expansion economically. We still have a lot of growth to go in this world. And if you live here in the US or Canada or UK in a very developed country, just be ready for that. It's going to happen. We can't grow at the same rates of these smaller countries whose average individual makes $5,000 or $10,000 a year and we make 70. I was actually surprised. UK only makes $46,000 a year per person.
It's a lot less than I would think.
I would have thought pretty close to us.
Yeah.
Very expensive country.
I was about to say, I can't believe it's 40,000 for, did you say 40 or 45?
46.
46 for as expensive as it is.
Yeah.
That doesn't go very far.
So back to what I was talking about shares outstanding. They're buying back shares, but guys, we don't want companies to buy back expensive shares. They're taking your cash that you own a piece of as part of owner of the company and using it to invest in something that's overpriced, potentially. That's the problem. If it's overpriced, they're buying back expensive shares. We want a company buying back cheap shares. That's a good use of your capital. So don't fall into the trap. We call it the silent killer of investing we actually call that when they issue more shares. But when you're buying back expensive shares, it's essentially terrible too. Instead of taking your money and I'd rather have them give it to us in a dividend and say, hey, by the way, how are they buying back shares and paying this huge dividend?
They haven't bought back shares in the last 6 quarters.
Oh, wow, really?
Yeah. So they kind of stopped. I'll keep going.
What, because they want to save their money to buy back shares? to pay dividends, I mean?
Let's see.
The dividends haven't increased that much. That's interesting.
Yeah.
Okay. So let's see what analysts are saying about Starbucks. Remember, guys, analysts have their biases just like you and I. Oh, wow, doubling their EPS in the next 4 or 5 years. From $3.50 a share this year to $7.19 in 2027.
That's a lot. They must be banking big time on the international growth.
Guys, that's big growth. Look at these high double digit, high teens, low 20% growth rate in their EPS. That's big numbers. That requires a premium to the company. If you believe those numbers and you believe they can still generate that, wow. Let's look at their revenue growth. Wow.
I know. It's huge. Was it like 11% on average? Yeah.
I would have thought it'd been much lower. I would have thought 4 or 5%.
Right.
Okay, let's factor that in there. So what do we have left?
Bull and bear real quick.
Oh, yes, bull and bear cases. I'm so sorry.
So as of January of 2023, they hold more than 30% of the market share of the coffee industry.
That's a bull case. 37% of the market share.
Forecasting same-store sales growth through 2025 of 7 to 9%.
Incredible.
That is really good.
Wow.
And their rewards program, they've been pushing this so hard, and I use it all the time.
Yeah,
I love their rewards program.
So does Lisa.
31.4 million users, 15% growth year over year. And as for the bear cases, pretty much everyth's union related.
This is, by the way, this is my biggest concern, guys. I don't care what your politics are. This union thing it's just going to lead to more costs. Because at the end of the day, Starbucks is going to want to give the money to their investors. So they need to make that 10% margin. It's just going to lead to higher costs for the consumer.
Operating margins contract 30 basis points due to committed investments in labor to include enhanced store partner wages and benefits. So you're already seeing margins going down because of it.
Oh, yeah.
So,
but by the way, doesn't Starbucks already offer some of the best benefits in the country?
This is when I was in my late 20s. I remember
which was like 4 years ago.
Yeah.
Okay, go ahead.
Maybe like 26.
Okay.
So like 8 years ago.
Okay.
But I remember people that worked there, they were like, we get great benefits, we get good stocks, we get everything. And I was like, and they're like, I love my job. And then this started coming out, this union stuff. I'm like, why? It seemed like it was a nice place to work.
Because somebody in San Francisco who chose to live in San Francisco and realized that it costs $8 billion a year in San Francisco says, I can't afford to live here.
So let's punish everybody instead of me just moving and being responsible.
If you don't like these comments, comment below. Just tell me what a prick I am. Heartless prick.
They could work at Starbucks and still be homeless in San Francisco.
What do you mean?
They don't make enough money.
That's true. I remember when Warren Buffett, he has like a step granddaughter who lived in San Francisco like 15, 20 years ago, and she was bitching because she couldn't afford health insurance even though she made $40,000 a year. And he wrote a letter saying to her saying like, listen, you make choices and you're a bright girl. You can make more money. You don't have to do all these things to live in San Francisco. You make choices on what you're going to spend. Kind of surprising from WB.
That's true.
So Stock Analyzer tool. Let's go into Stock Analyzer tool. This is our way of determining what price to pay today for the company based on our assumptions. It's been used over 2 million times since we started keeping track about a year and a half ago. And guys, it's probably the most popular tool on our software, but we have so many other tools right here and the community of like-minded investors you can chat with every day about your investment ideas. This is such a game changer. It's helped so many of our investors have one thing, 10,000 stocks at the palm of their hand, plus have a better understanding of investing and be able to sleep easier at night knowing they're making better financial decisions with a better process. So if you're interested in this, we're running a special, 20% off. Go to everythingmoney.com, sign up. It's about $1 a day. You're crazy not to do it. I really, truly believe that. We have people that have been on this thing for years. We met Dalton, our analyst, who'll be starting soon. I hope none of his bosses are watching right now. No, they're not. They're government workers, so they just care about their pension. All right, Mo.
Yeah.
Oh my God, look at this ROIC.
I know.
And increasing. So guys, what does this mean? This means they get an amazing return on the money invested in the business. And the good news is they can still grow the business, but how much capital can they really deploy? Even if they open 500 stores a year, how much does the average store cost to open? $1 million or $2 million?
I would assume, yeah.
Okay, so they open 500, let's say it's $2 million each store, 500 times 2 million is $1 billion. Okay, that's pretty good reinvestment rate to be able to get, but I don't think this is the actual marginal return. It's not like they were investing. Maybe it is, I don't know. But this is something to look into as an investor because this is such a high return. Keep in mind, Apple is like 37% or 38%. This is much higher than Apple. This shows a moat. People will keep paying this price no matter what. I've never heard anybody say, I'm done buying from Starbucks because it's too expensive.
Same.
The people who think it's too expensive never even started buying there.
Same. Yeah.
Right?
Yeah, you're right.
I've never heard anybody. What was that?
That's Dalton.
That's Dalton. Once Dalton starts making more money, he'll start growing up.
He'll start going to Starbucks.
Yeah, he'll start going to Starbucks. All right, so Mo, let's start with revenue growth. We're going to sit here and go line by line, and we'll at the very end hit the button. Make sure you watch this entire thing because we do engage about this software and how we talk about it. So Mo, give me revenue growth numbers.
How about 4, 7, and 10?
I refuse to put 4 in.
Okay.
And here's why.
I thought you said...
Go ahead.
You said you thought it would be 4.
Yes, but then when I saw like they were talking about 7 and 9% organic same store sales plus they're opening more, I think to myself 6% is the minimum you put in.
So 6, 9, and 12.
I like that.
12 seems high, but okay.
But if you have a little bit more inflation, have a little bit better growth internationally, 12 is not some absurd number,
okay.
Right?
Yeah.
Okay, profit margin.
I'm struggling with this one. Because I don't know where their margins are going to go.
Well, I think they'll end up stabilizing the margins because, Mo, it's just going to pass down to the consumer. This is a drug.
9, 10, and 11 or 10, 11, and 12?
I think 10, 11, and 12.
Okay. And do
10,
the same thing
11,
for
12.
margin.
Same with the free cash flow. Even though their free cash flow is actually higher.
It's higher. A little bit
higher. But I still like this. I still sit there and say, listen, let's keep it here. So, guys, what we're doing here is we're just applying a profit margin and a free cash flow margin based on that revenue growth. And all this program is doing is it's going to suck it back and say, based on these numbers, if you bought this company, here's the return you would make, and here's the price you should pay based on your return. Now for PE, the current PE is 30, and the current price of free cash flow is 38. All right, these are high. However, with a high moat and a high return on invested capital and decent growth, it can justify a higher PE. What I always do is, for big companies like this, I start at 15. That's the market average. And if the ROIC, the revenue growth, and the moat are very large, I go higher. If they're bad, I go lower. But most of the companies I look at, I'm looking for businesses that are going to be around for a very long time. So Mo, I think we're going to disagree on this PE, but why don't you go ahead and give me a low, middle, and high?
16, 19, 22.
I'm not going to lie to you. That was exactly what I was going to do. I thought you were going to go lower.
Well, I mean, I look at this and say, okay, if they could do 12% revenue growth and keep margins over their 10-year historical high, they are a moat.
And I look at Warren Buffett paying 30 times Coca-Cola in 1987 when he started buying.
In the drink world, this is pretty much as close as you're going to get to Coca-Cola.
I mean, Mo, like I said, like people literally, like I literally have a friend who says, don't talk to me before 8:30. I haven't had my drugs yet. When he says my drugs yet, do you know what he means? Starbucks. Yeah. He literally says, like, I haven't had my drugs yet.
Yeah.
I'm like, okay. All right. So finally, the desired annual return. Guys, this is where I talk about margin of safety. We sit here, you have to pick what return you want. You can get 9 or 10% from investing in a long-term ETF, right? So the question is, what returns do you want? The higher your assumptions, the more return you need, and that decreases the price you pay, which gives you more margin of safety. Mo, what you got here?
10, 12, 14.
Sounds good to me.
I don't think there's any reason to get fancy here.
Now, guys, I'm hitting the analyze button. A few numbers are going to pop up. Stay with me here. It's only about 1 minute left in the video. Remember, if you love this software, everythingmoney.com, 20% off. You're crazy not to do it. Let's go down and see the pricing. All right, low price 56, high price of 97, middle price of 75. If you paid $100, today's price for it, and then low assumptions occur, you'll make 2.5%. And these all include dividends. The middle assumptions occur, you'll make 8%. High assumptions occur, 13.6. Guys, I'm going to increase my watch list price. I'm going to go right here and increase it to $75 a share.
I'm going to 80.
Notify me.
Sell puts.
Oh, sorry, 80. And the reason being is I'm going to sell puts. And you want to understand that, subscribe to our channel and subscribe to our software. You can learn how to sell puts to earn money while you wait for stocks to hit the price you want to hit. Thank you very much. Everythingmoney.com. Check it out.